All right. Welcome back to another episode of Real Talk with JJ Jara. On this episode, I have a 24-year-old dude. I'm gonna call you dude, brother, because you're my son's age. He just literally stepped out, and I was very excited to bring you on because what you are doing with only 24 years of age, it's amazing, brother. So, with any further ado, Rob, please take the mic and introduce yourself. Let people know your name, where they could follow you. We're going to plug you in right away. We're not going to wait toward the end. We're going to plug you in right away. Social media, phone number, website. We're going to talk about your book, which, by the way, it's going to arrive at my house today. I'm going to give you a big shout out on my social media once I get it. And just a little intro about yourself, please.
Thank you for the huge introduction. Hey, everybody. My name is Rob Beardsley. I am a founder and principal of Lone Star Capital. We're a multifamily investment company. We buy 150 unit plus multifamily properties, primarily in Texas. And I grew up in Northern California. And when I was a sophomore in college, I actually got the real estate bug and started this company and dropped out. And that's what led me to running the company for 3 years now today.
Awesome. So Rob, one of the things I was sharing with you earlier before we jumped on the recording, it was that I noticed that you're pretty low key on social media. So let's not keep you in the dark anymore, brother. You have so much value, and that's why you're on the podcast. You have so much value to give to people, a lot of entrepreneurs like you and I, that I want you to just blow up, bro. Like so let's help you do that. There's a lot of people who are going to follow you through this podcast and the YouTube and all that good stuff. So how can someone find you on social, bro?
My Instagram is Rob_Beardsley. So it's just my name. If you just type in Rob Beardsley, you'll be able to find me on Instagram. Same thing on YouTube. Just type in Rob Beardsley, Lone Star Capital. You'll see I do a ton of educational content on YouTube. No real vlog style videos yet. It's all just hardcore content. I'm delivering the value. Yeah, those are the best place to find me. And a giveaway for everybody. If you want to head over to our website, lscre.com, I give away a couple things, but the most popular giveaway I have is my underwriting model tool, which is my deal analyzer spreadsheet that we use to analyze hundreds of millions of dollars of deals every year.
Awesome, bro. So give us that website one more time.
LSC for Lone Star Capital, re.com. So that's lscre.com.
Okay, pretty simple. So if you guys want to get a hold of this underwriting documents that Rob and his business partners use, go to his website and get a hold of this free content. Man, so let's go and dive in right into the good stuff. You and I met, was it a week or 2 weeks ago, brother?
It was a week and a half ago. And so, we're at this great event, and we just happened to sit next to each other during dinner. And through the power of connection, people connection, and just having a regular conversation, which is, I don't think that happens so much nowadays. We started to talk, and I found out that you guys own over 1,000 units, Rob? Yeah.
So 24-year-old from California, originally from California, 3 years ago started his own company with a business partner, and 3 years later, you guys own 1,000 units. Tell us how that happened. But before we go there, tell us, how did everything happen? Which you already told me the story, but let's go and tell the audience how that started.
Like I mentioned, I started the business in college, but so I grew up in Northern California. If you're familiar with Silicon Valley, it's all about tech. And so it's funny because I grew up in a real estate family. My parents were both real estate agents.
Oh, wow.
And very involved on the single family side, but they had no investment portfolio. They always told me, oh, you don't want to do this boring real estate stuff. You want to do this tech stuff because you're going to get rich through tech because, here we are in Silicon Valley. And so sure enough, I went to school for computer science. I like numbers, I like formulas and things like that. I was going through the motions and studying for those types of classes. But at the end of the day, I always had a passion for investing. And I always had a passion for building something that can grow and create passive income. I always thought the idea of having freedom via passive income is so key, because I always saw my parents, to be honest, worked so hard, and it didn't really matter how much money they made, because who cares how much money you make if you're just working nonstop? So they were working constantly, and I feel like they didn't have anything to show for it. And so I thought, wow, that's not how I want to live my life. Yes, I want to work hard. I love working hard, but I want to be able to point to my effort and say, see, that's what I did. That's what I built. Right. And so that's where looking at multifamily, bigger unit properties, buy and hold for cash flow, that's really where you can build that wealth, where you can build a legacy, and eventually looking really long term, it's something that you can pass down to your kids. So that's what really kind of, I got the bug and really started diving in and learning everything I could while in school through the power, like you said, of relationships, networking, mentors. I was able to both learn a ton and meet a lot of people in the space who were able to kind of accelerate my knowledge. And fortunately, just like we met at a conference, at a good event, I was able to meet my business partner at a conference, and we met and just were essentially trading notes and saying, oh, what deals are you looking at? And, before we knew it, we started working together. And so it's, again, the power of relationships there.
So the power of relationships. So I'm going to literally write that down. I'm hoping that if you're watching this video on YouTube, you're also taking down notes, because the power of relationships, it's, do you feel that's a good way to cut time? Like a nice shortcut?
Huge.
I feel the same way. So relationships are going to be important in anything you do in business. Now, let's stay a little more on the beginning part. How hard or how easy was it for you to start, Rob? Because a lot of people are going to focus on the, oh my God, 1,000 units. Oh my God. Oh my God. You own 1,000 units now, but you started at zero. So how was it in the beginning? How challenging was it? If any, like, how do you found your first deal? Tell us more about that.
There's some easy parts, then there's some really hard parts. And so definitely your first deal is always the hardest one. And it doesn't matter what size it is, right? If it's a 5-unit deal or a 50-unit deal or 500 unit, if it's your first one, it's your hardest one, because you're going to make mistakes and you're going to hopefully learn so much every step of the way, because everything is new. With that being said, the first deal for us was a very exciting opportunity that we were able to actually find in Houston, Texas. It was off market, meaning it wasn't publicly marketed by a major brokerage firm. The way that we were able to find it was we were hunting down a portfolio of properties on this block in this neighborhood of Houston. And we ended up getting outbid. It didn't work out. But from hunting down these deals and kind of searching up and down the block, we were able to bump into a broker who was then had a relationship with a group that was looking to potentially sell an asset right next door to one of the deals we had looked at. And so this goes to another, key factor is being local, being focused, and knowing the market is what's going to let you unlock opportunity. If you kind of just look half-heartedly at a bunch of different markets, you're never going to find those diamonds in the rough, because you just won't be able to go deep enough into that one market. So we were fortunate to be looking at that specific street, and then a deal pops up right next door to one that we were just looking at. So we know the deals, we know the area, and we were able to jump on it really quick, get aggressive, and put it under contract. And amazingly enough, that deal was actually 261 units.
People, listen up. First deal ever, 261 deals, or 261 doors in one deal. How nerve-wracking was that, brother? Were you able to sleep? Were you able to eat? Like I can imagine like how excited you were. I mean, tell me, can you go back and share with us how you felt your first first deal, 261 doors. That's a huge deal.
At first, super exciting, right? You get excited, but then you get nervous, and then the reality sets in and says, oh my gosh, what have I done? I now have to figure out a way to make this all work and make this happen. And especially when it's your first one, and even if it's your second, third, or fourth, there's so much that you need to do. Real estate's a team sport, and there's a lot that you have to bring to the table. And when you're just starting out, you yourself don't have a lot to bring to the table. If you're, an experienced investor with a big balance sheet, deep pockets, you could pretty much buy the deal all by yourself. You can figure it out, right? You've got your lender relationships, you've got your own money in the bank, you can sign a loan, you can qualify, all that stuff you can take care of. But when you're just starting out, you almost have none of that. So you're scrambling to find the key pieces everywhere. And so a big piece of advice is to try to get your team put together before the deal. This is the problem, is there's a myth in real estate that people think that if you have a good deal, the money comes, right? The money just takes care of itself. And I believe that. And honestly, the fact that I believe that, what I'll call a myth, helped me have the confidence to put that deal under contract, right? I didn't know any better. I was just starting out and I was like, 261 units, let's do it. But the reality is, and I don't regret it, it's a wonderful move, and you need to be ambitious. But the reality is, the money doesn't just find you if you have a good deal. You still need to put in the work, and you need to have the relationships. So if you can do that work up front before you have the deal, you'll have a more sane time when you're under contract, because when you're under contract, every day counts. And so if you can put the team together beforehand, you'll be in a lot better shape.
I love that. I love that. So, I wrote this two things down. I wrote down first commit, then figure it out later, because that's basically what you did. But then you give us another nugget. Have your team in place before, if possible, because it'll eliminate a lot of headaches, a lot of unnecessary things that obviously you went through, and now you're speaking out of experience. So tell me about the deal itself. 261 doors. How long did it take for you to close that deal? And what was it that you wrote down on the contract, and what was the actual thing? How did it play out?
I'm trying to remember what the exact terms of the contract were, but we drove these sellers nuts. I mean, this is an institutional, legit, seller, and they've got hundreds of millions of dollars of real estate to deal with, and they didn't want to deal with this small little, $20 million deal. But we drug these sellers through the mud. We told them, oh, well, we'll close in the standard timeline, which a standard timeline in the multifamily space is a 30-day due diligence and then a 30-day close. And then we got another 30-day extension after that. And then we still didn't have the money, or we had to switch partnerships or new management, and we needed another extension, and they wanted us to put up more money. And so then we had to scramble for more money and all these different things. And so I want to say, just looking back on it, I mean, it felt like forever, but I'm going to guess that we probably closed the deal at least 45 days later than the seller wanted us. But, thankfully they worked with us and we were able to end up closing. One thing my dad always says is, once you have a deal under contract, it may get ugly, but it tends to close. One way or another, these deals typically find a way of closing.
Just so you know, I'm learning a lot from you, and I'm sure that whoever's gonna watch the video and or the audio, they're gonna learn a lot. And I'm taking a lot of notes. I'm actually starting to do the same thing, but on the low scale. Like, I'm buying duplexes, 3 units, and one of the things that I asked you, how different is it from buying 2, 4, 5, 6 units to buying 261 units? And your answer was?
It's the same thing.
Same fucking thing. Oh, shit. Same thing. So what do you think is the thing that stops people from going into the bigger deals?
I'd say the biggest thing is mindset. There might be some little small things that you need to tweak or change or learn. Maybe the verbiage is different. Maybe the type of lending is different. But at the end of the day, it's all a mindset thing. You need to tell yourself that if it's what you want to do, because you can make money in the duplex, in the fourplex, you can build a really good business there. But if the bigger stuff is what you want, then you need to tell yourself that and convince yourself that you can do it. So
I'm writing this stuff down, brother. I don't know if you see me. I'm just going crazy here. I've never written this fast in my life before. But I'm loving everything I'm doing. So I'm sure people want to know. First deal, 261 in Texas, right?
Yep.
In Texas. How much did that cost you guys? Do you remember the sticker price?
Yeah. So it was actually a $15.4 million purchase price, and we had a roughly $2 million renovation budget to go with it.
On top or part of it?
No, that was something that we were handling with ourselves. We were budgeting that after we buy it, that we've got a renovation plan. Okay.
You're saying that it's the same 2, 4, 5, 6 units to buying 200 and plus units. You're saying the same thing. Most of it is mindset, believing that you could do it, and just a couple of things are going to change. But how much did it take you guys, or how much did it cost you guys to be able to lock a deal like this? I'm sure everybody wants to know. Do you put $1,000 EMD, or how much do you guys put down?
Yeah. So if you're not familiar what EMD is, that's your earnest money deposit. And when you put a deal under contract, you don't just get to do that for free. You actually have to put a deposit with the seller so that they know that you're serious and that you're actually at the table. And to show them that you're even more serious, some sellers require or want you to put the deposit non-refundable so that if something comes up, you don't get the financing that you wanted, or you inspect it and you don't like what you see, that deposit is non-refundable. And in Texas, because it's a very competitive market, that's what sellers often get. And so for this deal, we went non-refundable with an initial deposit of 300,000.
That's a lot of fucking money for your first deal.
Yeah, basically we had to borrow, my partner and I, we had to borrow $300,000 to put up as risk capital that we didn't even have to pay back if it didn't go well. We were, playing with money that we didn't have. So we had to be sure that we could make this work.
Okay. So for people that don't understand what's happening right now, because we're literally walking them through the whole purchase. So you found a deal, you came across a deal that just because you were in the market and you came across a broker that had a deal and that you connected with them, you came across a deal that's 261 units. And it required for you to put down a earnest monthly deposit, non-refundable of $300,000, which was not yours. You literally had to ask some investors to go into the deal with you. But you knew that if it didn't work, you're going to be asked off $300,000. So what's the fear like behind that, brother, if any?
Yeah, a lot of fear, a lot of crazy experiences. And I think putting yourself, you can call it back against the wall type of situation is one of the best ways to learn and grow, because every day we get up, we work hard, but nothing makes you work harder when you actually have that money on the line and you're risking everything and trying to make it work. And so they were just, I was in full go mode. I was making sure that I talked to every potential investor. I was making sure that we, were lining up the right partners for the deal and everything. And so it was definitely nerve wracking, but it was a great learning experience and super motivating, at the same time.
It was, but shit, man, I can't imagine how exciting you were, you and your partner, but also that was like an 80-day, 75 to 80-day deal from beginning to end that it took you to close this deal because of extensions and other things that came up. And so within 75, 80 days, you were going through some motions, weren't you?
Absolutely. Every day is a new day. And, you just have to be another big element of that. And why I think people should go through this experience or an experience similar is how humbling it is. It's like an entry-level sales job. Everyone should have to go through some sales job where they do cold calling or they go door to door or something like that humbles you, because I was getting up every day and I was humble. I was willing to ask anyone for help. I was willing to, hey, what relationship do you have? What introduction can you make? And those types of things. And so I was willing to cold call or warm call or whatever it was. I was willing to do it. And so you have to humble yourself in order to get that success.
I love the fact that you say that, brother, because there's a lot of people that want to do certain things in life, but they don't like to ask questions. And they don't like to get a little humble to a point where they show someone that perhaps they don't know certain things and that thing could stop them from growing. I remember when we first met, and I was like, "You don't know how many units?" I'm like, "Bro, talk." I think I even stopped eating. I was like, "Chicken can wait. I can eat some more chicken later. I got the rest of my life to eat some chicken." Bro, tell me more about what you're doing. And this is good, brother, because see, by asking great questions, you get a lot of knowledge. Now, I have a couple of questions to ask you. I'll run them down because I don't want to forget. How much of that money was your own personal money, if any?
Zero.
You got to be kidding me.
I've got no money. I'm a 21-year-old college kid. So
no money, but a lot of cojones to lock a deal for $15.4 million and telling a seller / broker, hey, I got you. I'm going to put in $300,000 non-refundable. So what happened? So take me there, because a lot of people are like, even myself, if I'm thinking of bigger deals, Rob, I'm thinking like, $300,000, shit, non-refundable. Takes balls, bro. You know what I mean? Do you already have that money, kind of those investors set aside, or do you just locked in and then went out there and find the investors?
In the real estate business, there's typically two ways that people go. They either will raise a fund and they'll tell their investors, hey, I'm raising capital and I'm going to start finding opportunities. And when I find opportunities, then I'll use the fund's money to invest. And then the other way, which is more common today, is to raise money on a deal by deal basis, which is better for investors because they can see and feel the deal and know the numbers. And it's good to give investors that confidence, but it's harder from the perspective of the manager, because you have a tight timeline. You have to do the dance of both putting the deal under contract and managing the due diligence and closing process at the same time as you're out there raising money. So we knew that we were hunting for deals. And like I said, we were in that market, in that neighborhood, looking for opportunities. So we were talking to some investors about, hey, we're going to be finding a deal soon. Hopefully let's keep in touch, and I'll share you the deal when we find it. But we definitely didn't have investors just lined up and waiting for us. And that's I would say is a mistake, looking back on it, but we didn't know any better. We didn't really know what we didn't know. And so, now in our business, we're much more prepared, and we know that we need to be constantly building our investor relationships and not just waiting until we have a deal under contract to say, hey, do you remember us? We have a deal now. It's constant outreach, constant education and comfort and those types of things. So yeah, that was we had to do that really quickly.
Yeah, no, I imagine. I mean, $300,000. How many investors do you remember? How many investors bought in for that 300 investment for the initial deposit?
I think it was about 2 or 3.
2 or 3. So you found three persons that are willing to invest a percentage of $300,000. And how do you sell them on something like this? How do you, I'm a salesperson, but I want you to tell me, how do you sell someone on investing about $100 and a quarter on a $15.4 million purchase? How do you sell someone like that? Do you remember how you sold them? Because you're the salesperson.
Well, I'm still learning, but number one, the deal has to speak for itself, right? That's the starting point. Do we have a good deal? And this couldn't have happened if we didn't have a good deal. Yes, it is possible for you to successfully raise and close on your own deal with it not being a good deal, but it's a lot harder. And for your first one, it's nearly impossible. So with that being said, we had a truly special opportunity. I mean, I had bankers look at it and tear our numbers apart, and they said, wow, this deal really checks out. So wow. That's the first step, right? The first step is that it's a good deal. And so that people are willing to overlook whatever experience you lack because you brought a good deal to the table. So that's step number one. Number two, it's understanding that, hey, this is your first deal and you need to be willing to share in the pie, right? You shouldn't be looking to charge the highest fees on your investors or take more equity from them. You should give them a fair structure. Don't go too cheap, because then they're going to think something's wrong with the deal or something's wrong with you, right? Yeah. Don't say, hey, I'm going to do this deal and I'm going to give away the farm, because that doesn't, investors don't like that either. It makes them uncomfortable. So take your fair split, but understand that if someone's bringing money to the table, like if they're going to give you money early, like for the $300,000 EMD, understand that they're going to need some additional compensation, right? You need to give them a little more juice. So that's how we did it. We were happy being a small piece of a very large deal for our first deal, because, hey, now we've got the first one done. So we weren't selfish. We weren't trying to say, no, this deal's all for us and we're not going to spread the love. We brought in various partners that helped us we brought in partners that were able to bring their investors to the table. We were able to bring in a management partner that had experience, and we were able to basically leverage their name and say, well, hey, this group is coming on board. That's making the sponsorship team look more experienced.
Okay, so you brought in a manager along with the deal?
Yeah.
Okay.
Yeah. I
And
mean,
so,
that's very, go ahead.
no, and I was going to say, so give me the importance of bringing a manager to manage the whole deal, like the importance of that.
Yeah. So it's pretty rare for your first deal to self-manage the property management side. That while you can do that, it's difficult to have that all set up. So that was where we were at. We wanted to hire a third-party management company. And so instead of simply hiring just a third-party management company that would handle the deal for a fee, we brought in a partner that would actually partner with us and agree to put money in the deal and sign on the loan, which is another big key component of the deal that a lot of people don't realize they need or overlook the importance of when they're going after their first deal. You see, in the commercial space, getting approved for a loan is so different than on the residential
Right.
space. And the way that it works is you need to have, if you want a $10 million loan, you need to have a net worth equal to the loan amount. So you need to have a $10 million net worth if you want a $10 million loan. Similarly, you need liquidity. So you need cash in the bank, stock portfolio, and that needs to be 10% roughly of the loan amount. So you need $1 million in the bank. And when you're starting out, nobody has that, obviously. So you need to find a partner who's willing to actually co-sign on the loan with you and provide that net worth and liquidity. Oh, and by the way, the lender doesn't want to give a loan to anyone. They want to give it to someone with experience. So they need to have that experience element as well.
And so I'm loving this because that part is, I just think it's brilliant for you to bring a business partner, a management team or manager that's going to manage the properties as a business partner, give them a piece of the pie, like you say, that has the liquidity, that has the experience, and has the funds. Is that how you were able to supplement that requirement from the lender through your management team?
Yeah, exactly right. Otherwise, we could find it somewhere, but we had to scramble and make it happen. And that goes back to getting your team together early. It's never too early to identify your co-signer. You don't have to wait until you have a deal to find a co-signer.
How do you structure the percentages on a deal, on a partner? You don't have to give me the exact numbers on your partnership, but what do you think would be like a fair, something like a ballpark, some fair that will entice a partner on the management side to come in as a partner, as a co-owner, rather than just a property manager to manage your properties? What do you think would be something fair or smart?
Yeah, right. It depends on how the deal is set up, but many of these deals are structured with a GP and an LP. And so the GP is the general partnership, and that's the partners that are actually the active managers of the deal. And then the LP are the limited partners, and those are people that are simply passive investors putting in money. They have no responsibility, they have no liability, they're just a capital partner. On the GP side, if you want to bring a manager in, I would say you need to give them somewhere between 5 to 10% of the GP equity in the deal. And so the GP owns a small piece of the deal and gets a compensation performance. So a performance compensation. So what that means is as you're doing the deal, if you give your LPs, the limited partners, a minimum return, any return above that, the GPs now start getting a piece of it. So it incentivizes the GP to outperform and do well, because then they make more money as the deal gets better for the investors. And so if you give the manager or the management company a piece of that, that'll also motivate them to make the deal a success, right?
It's an incentive for them. I see
Exactly.
that. I see that. And who taught you who taught you to go that route? Or is it something that you just like thought about and thought it was going to make sense? Or where do you get this formula from?
These types of formulas or these relationships you're able to get by networking and going to different meetups or conferences and things like that. So that's what I started just becoming like an event junkie, and I wanted to meet everybody, and I wanted to just learn everything that was out there and figure it out. And so that's how we were able to see kind of the opportunity. And I don't know. I mean, I think it was just kind of in our ambition to want to do something bigger, but we you can realize, you can say, okay, well, I can be more patient. I can go more slowly, and I can probably get a smaller deal, but keep more of it for myself. Or I can do a bigger deal. I'll end up with less because I'm giving it pieces away to other partners, but at least, but you're getting a bigger deal. So it's just kind of what makes more sense to you.
Yeah. So if you're watching the video right now, we're gonna leave the best part towards the end. So make sure you stick around, and we're gonna let them know at the end how much this property that you bought for 15.4, how much the value of it now, and the revenue, because I'm sure people want to know how much is that making you 3 years later, and which I'm sure is a good number. But you have to wait till the end for you to get this information. But I have another question, brother. How important is the underwriting part on such a big deal?
Yeah, the underwriting is potentially the most important part, because, and if you're not familiar with what underwriting is basically the financial analysis. It's the crunching of numbers to figure out what price you should pay for the deal, what returns is the deal going to kick out, and what you can sell the deal for in the future. So underwriting, as you could tell just by that description, is super important. And it's what you use to, number one, figure out, is this a good deal or not? What should I be paying for this deal for it to be a good deal? And then number two, you use your underwriting to pitch the deal to investors. You have to show them your underwriting, and they have to look at it, and they have to believe in your numbers, because you're not just throwing random assumptions at the deal. You're actually putting together defensible numbers in terms of rent comps, sales comps, and management pro formas and budgets. So you use it for showing investors the deal, and also for lenders. You have to show a budget to lenders so they can decide, okay, does this deal make sense, and how large of a loan should they give to you?
Absolutely. So now, is the underwriting, is that something that if there's somebody that's brand new and wants to get into going after bigger units or just investing, is that something that you can learn easily, or that's something that is going to take a while for you to learn as to the underwriting?
I think it depends how much effort you want to put into it. It's definitely not something that is you just learn in a day, but at the same time, you don't have to go to school for 4 years and pay hundreds of thousands of dollars, whatever, to learn. I would say the best way to learn is to get that solid foundation. And like you mentioned, my book, because I feel so passionately about this topic, I wrote the book, The Definitive Guide to Underwriting Multifamily Acquisitions, because when I was learning underwriting, there was nothing out there that existed that was just a step-by-step, no fluff book on how to analyze deals. And so that's why I wrote the book, to just give away all the secrets, provide the step-by-step instructions that we use to actually underwrite deals. And I say, if you read that book and you start underwriting a deal every day, you'll have it down in 6 months. And like you mentioned, as a newbie starting out, it's probably the best way to focus your effort, because it doesn't cost any money to look at deals, right? You're not putting them under contract. You're not, trying to raise money or anything. You're just analyzing deals, and you're going to learn. You'll be forced essentially to learn so much about the business through underwriting. You'll learn about operations. You'll learn about debt, and you'll learn about return metrics. And so it's a great place to build that expertise, and then go out and start building the business.
So what we're gonna do, we're gonna add the links where they could purchase your book. Again, brother, I've already ordered mine. I should get it today. I'm glad that you mentioned that if they buy your book, they're gonna learn the underwriting aspect, which is, in my opinion, is the most important thing. Because if you don't know how to underwrite a deal, and you lock something down, and you show up to an investor and they look at numbers, they're gonna laugh at you if your underwriting's off. The credibility is down the drain. So underwriting is very important. Knowing how to do the underwriting the right way, no extra fluff here and there, is going to be key, and that's what you offer in your book. So make sure that we definitely add the link on the description here. Now, tell me about the structure on the percentages. And I know I asked you this when we first met, but you find a deal, you locked it down, you put $300,000 down to non-refundable as your earnest money deposit. How much how much was your total money out of pocket, out of your investors that you had to use to lock this down? 300 is EMD. What was the total amount?
Yeah. So the total required capital,
Yeah.
equity capital to close on the deal and execute on the business plan was 4.5 million.
4.5. And so obviously you had to sell your investors on a good deal. How many people did you had to pitch in order for you to find your investors?
A ton. So definitely over 100. And we basically ran out of relationships, and that's a problem in itself, right? And that's why it's so important, like you said, to be on social media and to grow your network and to have many people that you can attract to your business. And so that was something that we didn't have at the time, and something that we're now growing. But so what we did to solve for that issue is, again, going back to being willing to give away pieces of the pie. So we were able to bring in more experienced people that already had investor networks, those relationships built in. And we were able to go to them and say, hey, check out this deal. If you like it, if it checks out for you, you can show it to your investors, and then we'll bring you on as a partner. And so that was how we were able to go just partner by partner and have them bring their investors to the deal. And so we ended up having over 50 investors in the deal. And many of them we didn't know because they were coming in through other relationships.
So you mean to tell me you locked down a 261 door deal for 15.4 million, and you brought over 50 different investors to buy into a 4.5, because that's basically what it is. You needed 4.5 to close the deal. It took some structuring to be able to do that, brother.
Yeah, it's these are expensive deals. The lawyers get rich off these deals. So, whether if you don't do 50 investors, the structure of the deal can still be complex. But what is very common is for these deals that do have many investors like this, is what you do actually is you actually have an attorney prepare a securities offering, and what you're essentially doing is you're selling stock ownership into the company that owns the property. And so there's laws and regulations about how to do that. So you need to have attorneys who specialize in not just the real estate side, but also in the securities side, and make sure that you're doing everything correctly by the SEC.
So on top of all this, there's got to be attorneys and all these legalities that, depending on the state that people are going to be investing, they're going to vary here and there. Now, 50 partners, but I heard you say that you had to go through someone to bring in someone else, meaning on one investor you had to have two investors. Does that make sense? Is that what you did? In other words, you went to a JJ that perhaps I didn't have the money, but I knew somebody that had the money, and you said, JJ, if you bring him to invest on the deal, I'll make you somewhat part owner. Is that how you did it?
Yeah, that's right. Let's say you have some experience and you have investor relationships, right? I can come to you and I can say, hey, I know that you've got some investors that are ready to invest. Can you go and round up $500,000 or $1 million by talking with your investors? And if you do, you bring that money in, I can give you a piece of the deal without you even putting any money in yourself.
Interesting. And just wow me with this. How do you structure something like that, man? Like, how do you entice someone to go in and literally just kind of say, look, trust me, this is a good deal? Because there's got to be some enticing, some selling in that.
Yeah. And that brings up a really important point about the investment business, which is trust. So we'll get to that in a second. But in terms of selling, it's actually a little bit easier, I would say, when you're talking about more sophisticated partners. And so when we were going to people who did have many investor relationships, they had experience, they knew the business well, and they could raise $1 million, it was an easier conversation because we could show them the numbers, dive right into actually what's going on. Whereas with investors who are less sophisticated, like let's say their day job is they're a doctor and they've got extra money laying around, they want to invest, but they don't really know what they're looking at. the way that you win those investors over is with trust, right? They have to know, like, and trust you, and they have to buy into your vision, but they maybe don't fully understand it. Now, with the more sophisticated guys, yeah, trust is important also, but they're going to really dive into the numbers and want to dig in and make sure that everything checks out. And so that's, we had to do a bit of both. Obviously, we had to build trust and we had to show the numbers as they were and pitch them and say, look at the opportunity here.
So just help me out here. So I have let's say I find a deal and it's 5 million, of here in California, it's probably like $5, right? But let's just say it's $5. It's like 5 million. And I don't have the funds for the earnest monthly deposit, but I have the structure, which is you're teaching us right now. And I know somebody that could be a partner. What do I say to that somebody that knows somebody to bring him in? What percentage do I offer to him, and what percentage do I offer to that person that has the capital?
Right. So the industry standard structure has a few components as to the way that the manager, which would be you, gets paid. Mm-hmm. You are entitled to an acquisition fee, which is paid up front, right? And that compensates you for finding the deal, for taking the risk of pursuing the deal, and of course, structuring it, closing it. And then the other fee you get is an asset management fee. Asset management fee is compensating you for keeping your attention on the deal after it closes, right? Just making sure that you have, the proper resources to focus on making sure the deal performs. So those are the two main fees. And then the big one where you can actually make a lot of money is on the promote. And the promote is the performance compensation. And that's what we mentioned earlier. And so what's typical is, as the manager, you can get 30% of the profits upon sale, for example, after you've paid your investors a minimum of 8% return, right? So that's a very standard structure that I just went through. So basically, if you, the manager, are entitled to, let's say, a 2% acquisition fee and a 30% promote, what you can do is you can go to a partner and say, hey, I know you've got rich friends, or I know you have investors. If you can bring me, let's just say, half the money that I need, I'll give you 10%. I'll give you 10 or 20% of the promote, or of the GP's economics. So I'll give you, let's say, 20% of my acquisition fee. I'll give you 20% of my performance compensation. And so that's how you slice it up, right? You first have the structure with the investors, and then you can have the division of this compensation for the manager.
I get it. Now, what will be something that's appealing, that's fair, that makes sense for an investor? I heard many people that offer like an 8-10%. On an annual basis on their capital. Is that about right?
Yeah, the most common one you see is 8% preferred return.
Yeah, 8%. And now is part of the exit strategy a different percentage that is offered to the investors? Like, let's say you sell it 5 years from now, do they get part of that piece of the pie too, or only on their capital investment?
Yeah, so every structure is different, but if we're focusing on that standard structure where they get 8% on their money, let's just say that the first year was a tough year and you didn't pay them anything, right? 0%. That 8% that they were owed for that year would compound and accrue to the following period. So then in year 2, you would effectively owe them 16%, and you'd have to catch them up and so on. And so theoretically, let's just say you never caught them up, and then you sold, the profits upon sale would first go to catch them up on their 8%. Then it would go towards paying them off. And then after you've paid them off, given their original money back, now you can share in the profits at the typical split of 70-30, right? You give them 70% of the rest, and then you take your 30%, which when we're talking like a $20 million deal or even a $10 million deal, right? That profit that you're splitting up could be $1 million. So you could make 300,000 as the manager.
Yeah, that is amazing. So when you come in like this deal here, do you lock it down for a specific amount of time for a time period, or do you go and sell your investors as 5-year period, then we'll sell 10, or based on the pro forma, then we'll sell? How do you structure such a big deal like this, brother?
Yeah, and I think you want to be careful with this, and it's all about managing expectations, because the worst thing, I can't say the worst thing, but a bad thing that you could do is give an investor the wrong idea about the deal, and then they invest, and then now they're complaining and they're asking all these questions because in the end they weren't a good fit for the deal. And so that's why, it may be tempting to tell the investor what they want to hear, but really what you need to do is tell them your business plan and tell them what you think is best for the deal. And if they fit with that, then they're going to be a good investor. So you want to make sure that if your vision for the deal is a 3-year timeline or a 7-year timeline or a 10-year timeline, that you tell them so that they're in alignment. Because the biggest headache you could have is an investor who's bugging you and wants out of a deal. And these deals are illiquid. It's not the stock market. You can't buy and sell whenever you want. So you're making long-term relationships when you're doing these deals. So for us, we tell our investors, depending on the deal, that we plan on owning the property anywhere between 3 and 5 years. So if it's a shorter term deal, we tell them, hey, we're thinking around 3 years. And typically investors in the shorter term deals, the shorter the better, right? Because you have short term investors. Mm-hmm. Now on the longer term deals, for them, it's the longer the better, right? So you just kind of have to make sure that you've got the right investors in the right deals.
Okay. So when finding a deal, it's also key to find the investor that they're aligned with your business plan. So if your business plan says, we're going to sell in the next 2 to 3 years, are you good with that? Yes, I'm good. Or no, I'm looking for more long-term investment because I'm going to make more money in it. So find the right investor is key then, and being upfront with your business plan is very important then. Okay.
Yeah, exactly.
Yeah. So a couple more questions, brother. Obviously this is all good. There's a lot of people that are going to find value if they want to go ahead and get your book. I'm going to put in the link. If they want to go ahead and reach out to you for some mentoring or coaching, because I know you offer that as a value, as additional value to a certain amount of people. What would that look like? Will it be one-on-one Zoom calls? Will it be will they be able to tag along with you on some properties, or what does that look like, just in case somebody wants to go ahead and hire you?
So yeah, right now, for now, I have just my top tier mentorship program where it's very hands-on, one-on-one, obviously phone calls, text, Zoom. I mean, you basically are just getting me as a partner, and we make sure that we get everything in place so that you're not making mistakes or scrambling at the last minute, so that you're able to confidently close your first deal in 6 months. So that's the goal of the mentorship. And that's like I said, it's a very private, very hands-on experience. So it's kind of a high ticket item. I am working on, especially after having some conversations with you, seeing about ways that I can give more value to people aside if they can't afford or they're not ready for such a big commitment. So some of the things I'm working on are rolling out an underwriting course. So a really good way if you want to dive in and commit a week or 2 weeks to just mastering underwriting. I'll be launching an online course where you'll be able to, breeze through modules and learn as you go. And we'll see what other things that I can put together and provide value.
Awesome. I love that, brother. There's going to be a lot of people that definitely going to want to buy multi-units with zero money out of their pocket, because literally this is what you and your business partner did. Now, a couple more questions, then I'll let you go because I know you're a busy man. So tell us again, how long ago did you buy your first unit, 261 units? Back how many years ago?
So that was 2.5 years ago.
2.5 years ago. And you bought it for 15.4 million. You ended up investing the 2 million in renovations after all?
Yeah.
Okay. Now, just so I know and everybody else knows, that other additional $2 million that came from the 50 investors.
Yep.
They all knew about it. There was additional renovation costs. You split it among all 50 investors. Is that it?
That's right. Yes.
Okay, good. Now, let's go and give them something exciting. Like fast forward to now, 2.5 years, you're just going crazy. You almost had to end up in the madhouse. Luckily you didn't. But now 2.5 years later, here you are with 261 units plus more. But let's go on this one here. Tell everyone what's the value of those units right now.
So today the property's worth 22.5 million. So we've experienced, we successfully turned around the property. It had a bad reputation. It had bad tenants, low occupancy. We were able to lease the property up to 90% occupancy, raise rents 20% by renovating the apartments, putting in new appliances, new flooring, paint, giving the property new character, upgrading the fitness center, business center. So, through all that, we were able to increase the value. And then also, the fortunate thing about real estate is it just tends to increase in value over time. And so if you're on the right side of time, you get to experience appreciation. And in the multifamily space, there's something called cap rate compression, which is the way that property can increase in value as well. So yeah, we've been very fortunate to have seen the opportunity and then pulled the trigger.
Awesome. So now the property that I bought at 15.4 is valued at 22.5. Your investors are loving you right now, right?
Yeah. So we're actually going to be considering a sale probably towards the end of the year or early next year. And investors should, really hit a home run with 20% average annual returns.
Awesome. That is amazing, brother. And now that you have these investors, obviously they bet it on you and that they know that you guys did a heck of a good job. Are they investors that are buying into your new deals or how does that work?
That's a really interesting point. And I think, now that I've been through these experiences, I know what I would do differently or how I would be able to do it better if I did it again. And so some key pieces of advice are, if you're doing that first deal, you got to make sure it's a good deal, right? And so I was just lucky enough that it was, and it happened, right? But you need it to be a good deal for more than just one reason that, you need a good deal. You also need it to be a good deal because that's going to be your first deal that you're going to then use to tell investors and educate them about your platform, about your history, and get them to invest in the next one. And so it will make your ability to get the next one done easier and easier. And then the other point about that is, and this is something that, I wish we could have maybe done a bit better, was actually sell the property quickly. And I know that some people have longer term horizons and things like that, and that can work, absolutely. But I think for your first deal, especially if you can buy it, prove out an increase in value and sell it, now you've got a proven history where you can show investors and say, look, I bought it, I sold it, I gave you your money back and a profit. Now let's go do it again. They're all going to be ready to go. Wow. Now, some investors of ours, they're ready and have invested in other projects with us because, they don't need to see that full round trip to buy into the process. But other investors, they've told us, hey, listen, we're going to wait until this first one sells in order before we invest anymore. Totally get it. So you have to understand that you're going to have some investors that are going to want to be patient with you.
Yeah. No, and that's something that I really wanted to find out because obviously I think that your first deal builds credibility on you, your business, your pitch, your value proposition. And so this one here, I think it's built a platform for you to be able to acquire the rest of your 1,000 properties. So now, less than 4 years in the business, you and your business partner own over 1,000 units.
That's right.
How good does that feel, brother? Like I'm here. I am trying to, honestly, man, I'm like, after I've met you, I'm driving back home with my wife, right? I introduced you to her, and I'm driving back home, and I'm like, hey, she's like, what? Guess what? Rob, I was, sitting right next to him having dinner. He's like, yeah, dude owns over 1,000 freaking units. He's only been doing it for 3 years, 24 years old. Here we are, want to go after freaking 20 duplexes. I'm like, no, so crazy. No. So how does it feel, bro, to own and know that you own over 1,000 units? How does it feel?
Yeah, day in, day out, I don't really think about it. And I'm just so busy hustling and thinking, oh my gosh, I need to get to 2,000, I need to get to 5,000. But yeah, when you say it like that, it definitely makes me feel good. It makes me, I'm not where I want to be, but I know that when I hear that, I know that I'm on the right path.
That's brother. I mean, 1,000 units. That's a big effing deal. I mean, shit. A lot of people go their whole lifetime without even owning a home. Think about it. Like I do sales, just like your mom and dad. That's my primary business. And I know there's a lot of people that go their whole lifetime just renting, never owning a piece of real estate. So to own 1,000 units by the age of 24, brother, I gotta tell you, bro, congratulations. I just had to throw the fuck in between because it's amazing, bro.
Thank you very much.
How does your parents feel about you right now? Because I know you said that obviously they wanted you to do the whole college thing and the whole formal education, which all parents want for our kids. But how do they feel now, man? How do they feel now? And what kind of conversation you guys have?
Yeah, when I first dropped out, there was kind of some tension and some kind of like, well, we'll see, maybe you'll go back to school and things like that. And at this point now, they also buy into the vision and they are very proud, and so that feels good. And it's great to be able to share in the success and bring them along the journey.
Absolutely, man. I can imagine. My daughter, I don't know if I mentioned this, my daughter, my son, 2021 and 24, bought their very first fourplex last year here in California. And as a dad, I was proud, brother. Imagine I was like telling the whole world, man, my kids so proud. I imagine that. Now I can imagine 1,000 units. So I got to tell you, brother, from a parent's perspective, I know your parents are truly proud of you. Shit, man, I'm proud of you. Freaking 24 years old, freaking doing big moves. That's a lot. Now, before I let you go, what are your plans? What are some of your things that get you excited for 2021? If you want to share any.
Yeah, well, the big goal for 2021 is to acquire $100 million of property. And so if the average price per unit, which it often is less than 100,000, but if it's 100,000, then that's 1,000 units. So 100 million, 1,000 units, that's kind of the goal for the year. So we'd like to, essentially double the portfolio in 2021. And the reason why, I mean, that's a great goal on its own, but that goal will allow us, it'll unlock the door for us to build out our own management company and scale into other complementary businesses. So it's a big year for us. Awesome,
man. I love the ambition, bro. I love the big goals. I love the fact that you're out there gaining, man. And I love the fact that you just went for it in your first deal, which now you going back, you said that you probably would have done it a little different. But brother, just because of you having that commitment, the courage, you are where you are now. And that is good. 3 advice that you'll give to someone that's considering getting to commercial investing into rentals. What will be your 3 top advice that you will give?
So number 1 is make sure you know what you're talking about, because you don't want to hold yourself back and be embarrassed or nervous or psych yourself out because you don't feel like you know the exact right things to say or the verbiage and things like that. So that's kind of the number 1 thing, or my first one is just, learn the language, learn the business. That way you have the confidence to talk to people. And then step 2, once you have the confidence to talk to people, this kind of almost contradicts number 1, is be willing to ask questions. Like you were asking me fantastic questions at dinner. You're asking me fantastic questions now. Like that's allowing you to learn. And that's how we learn from each other. And so being willing, first having the confidence that, hey, I belong in this room, I belong in this conversation. And then step 2, humble yourself and ask the questions. Don't be afraid. The dumb questions can potentially make you the smartest. So that'll be number 2. And then number 3, I think kind of what we mentioned earlier, the cliche of just, set the mindset and just go for it and figure it out, because with the right persistence and relationships, you'll get to where you want to go.
I love it, brother. I love it. But Rob, I'm literally blown away, brother. I hardly ever take notes on my podcast. Look at this shit. This podcast was mainly for me, man. You know what I mean? I do everything to help people, but sometimes I just have to be a little selfish and just think of myself so I can then later help other people. Does that make sense, bro?
Absolutely.
And I just got to tell you, bro, I'm stoked. I'm very proud of you, bro. I'm glad we sat down in the same table and we were able to meet each other. I'm very excited for you, brother. I can't wait to see you hit your 1,000 units this year. Let me know as soon as you put your underwriting course together or whatever it is that you want to do, because I'll be your first customer, bro. I support full-blown entrepreneurship. I support people that are out there getting out. I support people that they just freaking just doing what it takes, and people that are willing to get back. Because see, what you're doing, brother, you're willing to get back, because a lot of people don't do that. You agree? A lot of people just keep it and like, no, this is my secret. I can't tell you. And so you're willing to get back, and that shows a lot about who you are. So I'll be your very first customer, brother. I'll love to learn from you. Age doesn't matter, man. You're way younger than me. You're like almost half, like 20 years younger than me. And but you just that arena and that part of business, you're dominating, and I want to learn from you. I have no shame in saying that. There's no shame in that at all. And I'm just looking forward to connecting with you in the future, brother. Thanks so much for being part of this podcast. A lot of people are going to learn from this. A lot of people are going to reach out to you from this, brother. So good, nothing but good vibes for you. Last time, give us your Instagram handle. We're going to blow that up. So where can they follow you on Instagram?
Yeah, so check me out on Instagram, that's my email, Rob_Beardsley. So that's my name, Rob Beardsley. Check me out on YouTube, same thing. Just Google my name. You'll find everything you need to see. Like I said, articles, videos, tons of content. Thank you so much for an awesome podcast.
You're very welcome, brother. And I'm just going to finish it up with this. Rob, 24 years old, over 1,000 units in less than 4 years. He's coming up with some great coaching programs, with some online courses. I mean, like if you want to do one-on-one coaching, reach out to Rob. Follow him on Facebook, Instagram, freaking on Twitter, anywhere. You go stalk this guy, like be a little stalker, you know what I mean? Learn from people that could teach you how, and if you apply the right things, within 4 to 5 years, literally you could turn your life around. He did it. And I'm sure anybody else could do it if they follow the blueprints, which you're putting together. By the way, again, I'm a big reminder. I'm going to go ahead and tag and add the link to your book. Super excited, brother, for this podcast. Thank you again for being part of it. And until the next one, we'll connect. Awesome. Let's go.